Given the confusing terminologies and daunting words in the field of investing, I am here with you today to give you a brief overview of the different types of dividend investing. I hope that this will give you a bit of an insight into these. Kindly keep in mind, however, that all these are based on my own due diligence and thus reflect only my opinion. Hello and welcome to Investor Facts, where we address all your investment needs and questions. Stick around till the end of the video to learn more about investing and to be one step closer to that financial freedom you've always wanted. Investors who want to live off dividends must put together a diversified portfolio of dividend-paying securities that will generate enough income to cover their outgoings. While dividend growth stock like Johnson & Johnson can be relied on exclusively, I like to look at options that provide investors with dividend yields that are above average. I'll start by discussing real estate investment trusts, or REITs, as dividend investments. Except for dividend stocks, these are among the oldest dividend investments. An REIT is a business that owns, manages, or funds income-producing real estate individuals who may not be familiar with the term. They must distribute 90% of their profits to investors as dividends by law. Equity rates and mortgage rates are the two different sorts of REITs. In contrast to mortgage rates, which offer finance by acquiring or creating mortgages and mortgage-backed securities and making money from the interest, equity rates are the owners of real estate and collect rent from renters. In the United States, more than 160 REITs are publicly traded. One of the REIT's most significant benefits is that they might be the simplest investment method in real estate. When the stock market is open, all you need to buy shares of REIT is a brokerage account. There is a long history of dividend increase for many REITs as well. Although equities REITs have a more substantial record of TIP growth, Realty Income, WP Carey, and Annaly Capital Management are few instances of REITs. Their stock tickers are O, WPC, and NLY respectively. Many REITs also distribute dividends every month rather than every quarter. In this video, REITs are considered one of the safer dividend investment kinds but have one of the lowest yields. For equity rates, the typical dividend yield is around 4%, whereas for mortgage REITs, the standard dividend yield is over 8%. Since its creation, most mortgage REITs have experienced a general decline in dividend payout. Despite the few drawbacks I just listed, REITs are undoubtedly one of the most acceptable investing options for someone seeking a greater payout and moderate level of risk. For those who want more excellent safety with diversity, many REIT ETFs are now available. Business development companies are the next group. BDCs are organizations that finance the expansion of small and medium-sized businesses. These are several similarities between BDCs and venture capital funds. A BDC is a public company. Therefore, you are not required to be an accredited investor to invest in one. BDCs must distribute 90% of their profits as dividend to shareholders, just like REITs. A while back, I created a graph to illustrate how they function. Your BDC, for this example, Ares Capital, is located at the upper left of the screen. Ares will put money into small or medium-sized firm, and these businesses seek BDCs in the first place for capital for various reasons. The company will agree to give up a portion of their profits in exchange for BDC money. As I said before, the BDC must distribute 90% of its earnings to shareholders once it profits. Ares Capital Corporation, ticker ARCC, Main Street Capital, ticker MAIN, and Prospect Capital, ticker PSEC, which all pay dividends every month, are a few well-known business development firms. Compared to equity rates, BDC dividend yields are often substantially higher. An average business development company has a dividend yield of 8%, though most companies pay dividends quarterly, others do so monthly. Generally speaking, BDCs are viewed as riskier investment than REITs. It frequently happens for a small business that a BDC lends money to file for bankruptcy, which puts a lot of strain on the BDC industry during recessions. Additionally, most business development businesses don't have a great history of dividend growth over time. According to Seeker Alpha, Ares, one of my favorite BDCs, only has 0.87% 5-year dividend growth rate. A mere 2.68% has been added to Main Street Capital's 5-year growth rate. While the dividends are excellent, the overall appreciation will be lower if that is a factor for you. Let's now discuss Master Limited Partnerships, or MLPs. Even though they have been around since the 1980s, they mainly work in the natural resources industry. One of the most excellent features of MLPs is that some offer absurdly high dividend yields that are frequently still increasing. Occasionally, some MLPs will pay dividend rates of 10% or higher. Examples are Cross America Partners, ticker CAPL, which gives an excellent dividend yield of 11.66%, and Icon Enterprises, ticker IEP, which delivers an excellent dividend yield of 13.73% and has been steadily raising it to this point. The K-1 tax form is the most significant drawback to investing MLPs, even though everything else seems great. You won't receive any unique tax paperwork if you invest in a BDC. An REIT closed-end fund, or any other dividend investments. But when it comes to MLPs, things are a little different because you'll also receive a K-1 tax form along with your investment. The typical investor finds dealing with these issues notoriously challenging, and they frequently need the assistance of a tax expert. The MLP may be required to file a state income tax for each state where it conducts business, which can be a major hassle if it operates in a numerous jurisdiction. The K-1 tax form won't be an issue if you invest in an MLP ETF like the Global X MLP ETF. We'll now examine closed-end funds, or CEFs. Closed-end funds are seldom passively managed. Instead, they are actively managed because each fund is hard selected by fund managers. CEFs often have more outstanding fees than passively managed ETFs. CEFs frequently have 1 or 2% or more excellent expense ratios, which is higher than the average expense ratio for passively managed ETFs, which is 0.44%. Due to the more excellent expenditure ratio, fees will have a more significant effect on the long-term capital growth of your investment. One advantage of CEFs over ETFs is that they can use leverage, despite their high cost and set share price. Leverage is a method closed-end funds utilize to raise payouts. It's not unusual for certain CEFs to have dividend yields of approximately 6%, and many CEFs have yields of about 4%. One of the most well-known CEFs, with the ticker code CLM, now has a dividend yield of more than 15%, while several have even greater dividend rates. Most CEFs I've encountered have a history of gradually cutting rather than raising their dividend over time. Despite this, many CEFs provide monthly dividends, which is excellent for investors searching for higher dividend yields. I'd probably include CEFs on my list because of these factors. Covered call ETFs are the following. To a certain extent, these exchange-traded funds employ call options, which are then employed to offer investors astronomically huge monthly dividends. QYLD, JEPI by JP Morgan, and NUSI are the three most well-known funds for this strategy. While QYLD is an ETF with passive management, JEPI NUSI, and the others are actively managed. They provide dividend yields that are high and rising. JEPI and NUSI currently offer lower dividend rates, ranging between 7 and 8% than QYLD, which presently yields 11.8%. But compared to QYLD, these products have traditionally offered higher long-term appreciation. You can accelerate the growth of your dividend portfolio with the monthly, extremely high, and increasing dividends offered by these covered call ETFs. The fact that these ETFs' dividend payouts fluctuate regularly is a drawback for a specific demographic. The compensation for the following month might be higher or lower than before. Therefore, contacting ETFs is not a good idea if you want a monthly dividend that always pays the same amount. Let's now take a closer look at exchange-traded notes or ETNs. Exchange-traded notes carry incredibly high risk. ETNs are so risky that their issuing financial institution has the right to delist them whenever possible. A short while ago, the UBS ETRAC's monthly pay 2L leverage mortgage REIT ETN with the ticker symbol MORL experienced this. It's the subject of an intriguing Forbes article. Your investment would have been entirely lost when the fund folded, which happened. Why would anyone want to invest in exchange-traded note, given the substantial risk involved? The extraordinary dividend yields are the solution. A massive result of 31.53% is presently offered by one exchange-trade note, symbol SLVO. Even MORL formerly provided investors with a dividend yield of 25%. However, remember that MORL failed, and your investment would have been wholly lost. Although those dividend yields are alluring, ETNs are not for risk-average investors. Well, there you have it. My thoughts on different types of dividends. What do you think? Do you agree or do you have different opinion? Let me know your thoughts in the comments. Once again, this is Investor Facts, ensuring that all your questions are answered. If you enjoy watching the video, kindly leave a like and subscribe. Until the next time, cheers!